Okay, here. All right, here's what we're going to do. Cancel the, I gave you a, no, do not cancel these orders. Keep these orders at 520 by 560 here. We are making lower lows in the, you can see the Dow up here. Watch my pointer, people, 443. So you took out yesterday's volatility. Volatility is running high. You can see here that this particular chart is Apple, and this particular chart over here is Google. We know that. We know that the options are here. We gave limit orders out. There's that 680, but we gave limit orders out there at 560 and 520. And that was long before they had dropped. But the beautiful thing about it is that in volatility, that yesterday's movement, now let's zero in on Google. This is the long trade yesterday that we got, because that's where it changed. Now, in bear market trends, you look to make sure what that teeny, so it's $2.10 per line. The platform figures it out. This info panel, there's your alerts. Here's the thing, is that if we base somewhere higher, it's called teeny beta delta expansion. Price expansion is delta expansion. So when bear market moves are being put in, they will have to be at a higher level than yesterday's level, as you know. And that this is not going to lie. It's at 15. You hit a 0.62. You know what that means. You're at 0.58, and it's made several intraday trend ratio, SMF trend ratio lows in the market maker application. And because of it, and the way that we traded the options on the opening bell, and the way that we made markets and showed you how to do the bid and ask and work that tape, as this tape over here is working, is that there is a key Pacific events that happen in bear market trends and bear market bottoms that get put in versus when you're in a bull trend and you're going to get ready to short it. That volatility is totally different than a bear volatility. A bull volatility reversal is different than a bear volatility reversal. And knowing where we're at and knowing that these were 1050, we finally got the spread. We bought these and did 2 transactions and made money. And that the volatility increases at bottoms, at bear trends, where the bear trend or the bear bottom will always have a higher degree of price volatility. When you're at a bull top reversal, yes, you will have extreme volatility, you will, but it won't be as big in directional price movement as the bear volatility MMTs. And I'm proud to announce to you that as you go through making markets on certain kind of equities, and how those bottoms are put in and how your platform guides you each step of the way. Doesn't lag price. And the strength of the pullback, wherever we find our intraday low, we must maintain in bear moves and bear bottoms, even in the indexes, but the leadership in the index. Google is the leader. Apple over here is doing the same thing. Apple right here, it's doing the same thing. Both are MMTs. So and look at Apple's low yesterday, okay? Just like this one over here, just like Google. They both got the same pattern, and they both have the same short pattern, okay? Naturally, Google's a little bit more higher. It's $2.10 a line, and this is $1.23 per line today with the public. And the SMF market maker application, it's really the SMF makes a market from the public tape. It converts the public tape into a market maker buy and sell transaction model. You can see over here, MMTs, the enjoyment of knowing bear market setups versus bull market reversals, and how the price volatility will continue to increase as the bottoms are put in. It's going to be the leadership equities such as the Apple and the Googles, within the bear structure of the trend that these leaders set up, well, then eventually what's going to happen is, and it's holding support level. I mean, look at the NASDAQ comp down 80 handles. Look at the NASDAQ 100. We were just down 445 points or so and gave up all of yesterday's price volatility. But look at here. We're both coming up in the same direction on the leaders. Okay? So by understanding that this stock right here, the IR on Apple, is now at 28.25, those high-frequency computing robot machines, artificial, it's not humans making the transactions, the probability is that they start to move this way until it stops and the probability goes up. It's machines versus man. Same thing over here. When you look at your 34 IR here, you can see that your current 0.62, we have come to 0.5. You can see it doesn't lag the price and it comes up. You can see where the indexes are. But you'll notice on both, that this one is stronger and this one is below 25. But look at 0.46. It's at 0.37. Google already did that. It already went down and made series of lows in these ratios that you trade. That's what you trade. That's a public print. Who cares? But this is what deciphers it. And each line, this is $1.23. It tells you right here, teenies, $1.23. Look at how accurate they are. Right down there to it, right up there to it. So really, the high frequency volume doesn't really bother someone like you, but the day trading community, they're going to have a very hard time dealing with it. And I think that they better come to grip. And the thing that they better come to learn with is that it's mathematically done on high. It could be done within 51 milliseconds in both long and short in the tape. They could jam the bid and ask to do all kinds of nasty things that day traders have never been taught because they weren't around when the day trading community started. It was just very fair buy and sell between the public. It's no longer that way. That's why we developed our mathematical scripts in here. And it's already got them figured out. So when the ratio goes higher, you go higher. And when that ratio drops, that's the volatility there in the Google. Okay? There's the Google bid and ask right up here. It's also right here. Okay? And the thing about it is, see, bid and ask. And we're putting in a fairly decent bottom here. And Apple will follow suit. Here it is. It too is coming up higher, and then that's when you know when those electronic bots are going up in value, is when that changes. MMTs and these change, and this is contracting. When that contracts, you break higher. Look at here, you're at 44. Look at here, right there, and that's how you know MMTs. And this gets above 55, you'll continue to break out there. Apple right here, live here and now. It's all live right here. And you can see it. You can see the thing right here. Just that 35 over here. See my pointer? See it? Watch it. Intraday range. Look at that. Doesn't lag. Look at that 32. If it goes below 30, you'll keep breaking. That's when you know the high computing, high frequency volume is leveraging up. You can see them both. Both are great entries. Look. 60, look, you know that the robots are going that way. This is done live. It's the only way, MMTs, you're ever going to learn this. No one else understands how to do it. This doesn't lag them. All right? Remember what I taught about your 10-minute period moving averages on here and what that means and why you would let the winner continue to run. Look at the IR builds. Look at these things drop. Look at this one drop below 30. Didn't I just tell you, this is Apple dropping below, when it drops below 30, it goes higher. So you got a 369, all high. But how do you know when those high computing, high volume frequencies are making moves that way or making moves this way? And how do you track them? Well, this is how. I'm at 31. I'm going the wrong direction. This got to go below 30 for this to go higher. This one over here is at 45, going the wrong direction. So the natural buyer has to step in to keep this probability going with those machines. It's called leveraging up. We levered down. Now we're leveraging up. And both stocks are the same, leveraging down, and they're leveraging up. And the only way you're going to know is by using your application. Look at how strong this is. Look at here. You're below 30. Look at here. Look at the price move. Doesn't lag, does it? Ha, ha, ha. Standard technical analysis does. This does not, though, because it's high frequency. Now, 3, 6, 9, 12 to the breakout. I'm at 61. I got to go above 65, but look at my ratio, 0.41. Look at here. It stopped at 0.62, and that's why you went up in price. And Apple's stopped right here. Apple stopped right here at 0.46, and as I said, when you go below 30, you go higher. It's right here. You can see it. You can see that 0.27. You can see the breakout. Let us not be in denial. This is how those high-frequency machines work. They work it the down way, and they work it the up way. And they create a lot of the volatility. Dow is only down 286, and everything is put in a low end like yesterday. And right now, the time is 7:34 a.m. We're 1 hour and 4 minutes into the tape. Today's date is 8/10/2011. Man versus machine in the transaction model, and how they work, and how you can tell when they're making their see, I'm at 31, so I got a wick here. I got to go below 30. There we go. I got to stabilize there. Here, 0.46. I got to go below 40. So as they make their moves up, then what they'll do is they'll lock the bid and ask in there with latency and then print down real quick, and sometimes you can't even see it. What you do need to know is that the volatility off the bottom of the Dow right now in the first hour is how bear market lows get put in from the previous day's low. And how the futures volatility, how the high frequency volume trading works, how that opening bell truly is going to work, how the trade management is going to be applied, how to work the bid and ask in the options. Last print was 780 over here. How Google and Apple make their moves, and how the high computing frequency machines work in the bid and ask tape. And it's really unfortunate because it handicaps all the people that just try to do the regular buy and sells. They're not being treated fairly. They have no way to keep up. The only reason why we can do it is because we built our own platform to it. And it's very sophisticated behind here. Otherwise, we couldn't keep up with it. So it's not, but there's a way to make a lot of money off of it. And so I'm buying here and I'm selling, and they're changing directions, and everything is changing direction. Let it be known that we had an intraday bounce at about the first hour of the opening bell. We were down 445 handles or something. We just bounced to 280, and now we're going back up, and things are changing here, and price goes down. That is the high frequency computing machines versus man-made entry and exits in the buy and sell transaction model over here. This is a machine transaction model, and humans, they got to try to figure out, well, how am I going to get in between the bid and ask here, and what's going on. Once again, MMTs, we're visiting it. We've been training you on it for a long time, and this is a premier MMT market maker video relative to high frequency and the directions of it, and how bear market trends set up, and how both are trying to consolidate here, and that means from yesterday's low to here, that's expansion, that's strength within the bear. And bear market volatility is totally different than bull market volatility, or bull trend volatility, or bear trend volatility, and how the trade management implies in bear trend volatility. And how do you know that the bear is trying to put a bottom in? And how do you know what the volatility is for them to buy this? And both leaders are doing the same on Apple here and Google here. Thank you, MMTs. Time, 7:37 a.m. Pacific Standard Time, 8/10/2011, MMT.